On Friday, September 12, 2008, Lehman Brothers executives held a conference call with investors and analysts. The firm had just reported a third-quarter loss of $3.9 billion. But management assured everyone that Lehman had sufficient capital and liquidity to weather the crisis. They said the firm's balance sheet was strong, that they had options, that rumors of bankruptcy were overblown. By Sunday night, September 14, less than 48 hours later, Lehman Brothers was filing for bankruptcy. $600 billion in assets, the fourth largest investment bank in America, gone. Monday morning, September 15, global financial markets went into free fall. Stock exchanges crashed. Credit markets froze. Banks stopped lending to each other because nobody knew who would fail next. ATMs were feared to stop working. The global financial system came within hours of total collapse. But Lehman wasn't the beginning. It was the crescendo. The crisis had been building for over a year. In Britain, Northern Rock had suffered the first bank run in 150 years back in September 2007, a full year before Lehman fell. In March 2008, Bear Stearns, America's fifth largest investment bank, collapsed and was sold to J.P. Morgan for $2 per share in an emergency weekend rescue orchestrated by the Federal Reserve. Through the summer of 2008, more cracks appeared. Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, were essentially nationalized. Lehman's stock price fell from $60 to single digits as investors lost confidence. And then that weekend in September, when the government decided not to bail out Lehman, the entire system broke. But here's what matters right now in December 2024. Everything that made the 2008 financial crisis possible exists today in more dangerous forms. Banks holding assets worth far less than book value. Commercial real estate collapsing as offices sit empty. Regional banks with massive unrealized losses. Credit markets showing stress. Government debt so high that bailouts may be impossible. And most critically, the same overconfidence that the system is safer now because regulations were strengthened after 2008. They said that in 2007 too. They were catastrophically wrong. Based on every pattern from 2008 and every current financial stress indicator, we're approaching a banking crisis in late 2025 or 2026 that will make Lehman look like a preview. The warning signs are visible. The vulnerable institutions are obvious. The triggers are in place. And just like 2008, most investors are completely unprepared because they believe that too big to fail means the government will save everyone. They won't. They can't. The debt is too high. The political will doesn't exist. And when the next Lehman fails, the cascade will be faster and more severe because everything is more interconnected and more leveraged than 2008.to understand why Lehman collapsed and why it's about to happen again. You need to understand the housing bubble that preceded it. From 2000 to 2006, American home prices rose faster than any time in history outside the Great Depression. In some cities, prices doubled or tripled in just 5 years. This wasn't driven by population growth or income increases. It was driven by credit. Banks were making mortgage loans to anyone who could fog a mirror. No income verification. No down payment. Adjustable rate mortgages that started with teaser rates below 3% but would reset to 8 or 10% after 2 years. Subprime loans to borrowers with terrible credit. The assumption was that home prices would keep rising forever, so even if borrowers couldn't afford payments, they could refinance or sell at a profit. Wall Street took these mortgages and packaged them into securities called mortgage-backed securities and collateralized debt obligations. They sliced the risk into tranches. They got rating agencies to stamp AAA ratings on securities backed by subprime loans to unemployed people. And they sold these toxic products to banks, pension funds, and investors worldwide, telling everyone they were safe because they were diversified and mathematically modeled. The big investment banks, Bear Stearns, Lehman Brothers, Merrill Lynch, Morgan Stanley, Goldman Sachs, all made fortunes creating and trading these securities. They were leveraged 30 to 1 or more, meaning they'd borrowed $30 for every dollar of capital. As long as housing prices rose, the model worked beautifully, but in 2006, home prices peaked and started falling. Borrowers with adjustable rate mortgages saw their payments double when the teaser rates expired. They couldn't refinance because home values had fallen below the loan amounts. Defaults began. Foreclosures accelerated. The securities backed by these mortgages started losing value. And the banks holding billions in these securities suddenly faced a problem. Their assets were worth far less than their liabilities. They were insolvent, they just hadn't admitted it yet. Through 2007 and early 2008, banks tried to hide the losses. They used accounting tricks. They valued assets at model prices rather than market prices. They insisted the problems were contained to subprime. But the losses kept growing. Bear Stearns was the first major casualty. In March 2008, two Bear Stearns hedge funds that invested heavily in mortgage securities collapsed. This triggered a run on Bear Stearns itself as counterparties and creditors refused to do business with them. Within a week, Bear stock fell from $70 to $2. The Federal Reserve arranged an emergency sale to JP Morgan for $2 per share, backed by $29 billion in Fed loans to cover Bear's bad assets. This should have been the wake-up call. It wasn't. Everyone assumed Bear was an isolated case of mismanagement. The system would be fine. In Britain, the crisis had already revealed itself earlier and more publicly. Northern Rock, a medium-sized British bank that had grown aggressively by funding mortgages through short-term wholesale borrowing rather than customer deposits, found itself unable to roll over its funding in August 2007 when credit markets froze. The Bank of England provided emergency support, but when news leaked, customers panicked. On September 14, 2007, queues formed outside Northern Rock branches across Britain. People camping overnight to withdraw their savings. £1 billion withdrawn in a single day. It was the first bank run in Britain in 150 years, and it shocked the nation. Eventually the government guaranteed all Northern Rock deposits and then nationalised the bank in February 2008. This was the visible warning that bank runs were back. By the summer of 2008, Lehman Brothers was in serious trouble. The firm had massive exposure to commercial real estate and mortgage securities. As these assets lost value, Lehman's capital cushion evaporated. The firm tried to raise capital. They sold assets at losses. They reported better than expected earnings through accounting maneuvers. But markets weren't fooled. Lehman stock price kept falling. Short sellers smelled blood. Counterparties started pulling back. By September, Lehman needed a buyer or a government bailout to survive. That weekend of September 13th to 14th, government officials, Federal Reserve, Treasury Secretary Hank Paulson, and executives from major Wall Street firms gathered to find a solution. Bank of America and Barclays looked at buying Lehman but walked away. The UK government refused to allow Barclays to buy Lehman without guarantees, which the US government wouldn't provide. Paulson, who had been Treasury Secretary for 2 years and had assured markets the system was sound, made the decision. The government would not bail out Lehman. They wanted to send a message about moral hazard, that firms couldn't take excessive risks expecting government rescue. Lehman would be allowed to fail. Sunday night, September 14th, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. $600 billion in assets. 25,000 employees. Global operations across 30 countries. And unlike Bear Stearns, there was no buyer and no bailout. Lehman was simply going to be wound down. Monday morning, September 15th, markets opened to chaos. The Dow Jones fell 500 points, nearly 5%, the largest single-day point drop since September 11, 2001. But the real crisis wasn't in stock markets. It was in credit markets that most people never see. Banks and financial institutions lend to each other constantly. Overnight loans. Short-term funding. These transactions are the plumbing of the financial system. But after Lehman failed, nobody trusted anyone. If Lehman could go from $600 billion in assets to bankrupt overnight, who else was hiding losses? Banks stopped lending to each other. The interest rate for overnight interbank lending, normally just above the Federal Reserve's target rate, spiked to over 6%. This was a sign of complete panic. Banks were hoarding cash because they didn't know if they'd survive. Credit markets, which are larger and more important than stock markets, essentially froze. The crisis went global instantly because European banks had massive exposure to American mortgage securities. They'd bought the AAA-rated CDOs. They'd lent to Lehman and other failing institutions. In Britain, the crisis escalated beyond Northern Rock. HBOS, one of Britain's largest banks, faced a run and was forced into an emergency merger with Lloyds. Royal Bank of Scotland, which had grown through aggressive acquisitions to become one of the world's largest banks, collapsed and required a £45 billion government bailout, the largest in British history. RBS was effectively nationalised. British taxpayers now owned the bank. The same pattern repeated across Europe. Banks failing or needing bailouts in Germany, France, Belgium, Netherlands, Iceland. But the most terrifying moment came later that week when money market funds broke the buck. Money market funds are supposed to be completely safe. They invest in short-term government and corporate debt. They're supposed to always be worth $1 per share. But the Reserve Primary Fund, which held Lehman debt, announced it had lost money and shares were now worth 97 cents. This triggered a run on money market funds. Investors pulled out $500 billion in a week. If money market funds failed, the entire commercial paper market that funds corporate operations would collapse. Companies wouldn't be able to make payroll or buy inventory. The economy would stop functioning. This is when the government panic began. On September 16, one day after Lehman, the Federal Reserve bailed out AIG, the insurance giant, with $85 billion. AIG had sold credit default swaps on mortgage securities, essentially insurance that paid out if the securities defaulted. When the securities cratered, AIG owed hundreds of billions it didn't have. If AIG failed, every bank that had bought protection from AIG would take massive losses. The contagion would accelerate. So the government, which had refused to save Lehman just days earlier, now saved AIG. On September 19, Treasury Secretary Paulson announced plans for what would become TARP, the Troubled Asset Relief Program. He asked Congress for $700 billion to buy toxic assets from banks. The number was essentially made up, chosen because it was large enough to seem serious. The plan was to remove the bad assets from bank balance sheets so markets would start functioning again. But Congress initially voted it down. The American public was furious about bailing out Wall Street while ordinary people lost their homes. The Dow fell 777 points on September 29 when TARP failed to pass Congress. This was the largest single-day point drop in history at that time. Eventually Congress passed a modified TARP on October 3, but by then multiple major institutions had failed or been rescued. Merrill Lynch, another bulge-bracket investment bank, was sold to Bank of America in an emergency merger the same weekend Lehman failed. Washington Mutual, the largest savings and loan in America, failed on September 25 and was seized by the FDIC and sold to J.P. Morgan. Wachovia, the fourth largest U.S. bank, nearly failed and was sold to Wells Fargo. Morgan Stanley and Goldman Sachs, the last two major independent investment banks, converted to bank holding companies to gain access to Federal Reserve emergency lending. The era of the independent investment bank was over. Bear Stearns and Lehman were dead. Merrill was absorbed by Bank of America. Morgan Stanley and Goldman survived by becoming regular banks. The economic damage rippled for years. The stock market would eventually fall 57% from peak to trough by March 2009. Housing prices fell 30 to 40%. 8 million Americans lost their jobs. Unemployment hit 10%. In Britain, unemployment rose from 5% to 8%. GDP contracted over 6%, the worst since the 1930s. Housing prices fell 30%. The recovery was slow and uneven. It took the S&P 500 until March 2013 to regain its October 2007 peak. Many people never recovered. Retirement accounts were decimated. Homes foreclosed. Careers destroyed. An entire generation became skeptical of markets and the system that had failed them. Now here's where 2008 becomes the blueprint for 2025 and 2026. Every element that made Lehman's collapse possible exists today in more dangerous forms. In 2008, banks held mortgage-backed securities worth far less than book value. In 2024, banks hold commercial real estate loans and securities worth far less than book value. In 2008, the trigger was residential housing collapse. In 2024, the trigger is commercial real estate collapse as office buildings sit 30 to 40% vacant because remote work has permanently reduced demand for office space. Regional banks in America are sitting on $650 billion in unrealized losses as of 2024. They bought bonds when interest rates were zero. Now rates are over 5% and those bonds are worth 70 to 80 cents on the dollar. They're only avoiding recognizing the losses because they claim they'll hold to maturity. But if depositors withdraw money, banks have to sell the bonds at losses to raise cash. This is exactly what happened to Silicon Valley Bank in March 2023. Depositors panicked, SVB had to sell bonds at huge losses, the losses wiped out capital, and the bank failed in 48 hours. First Republic and Signature Bank followed the same month. Commercial real estate is the subprime of 2024. $1.5 trillion in commercial real estate loans are maturing through 2025, 2026, and 2027. These loans were made when offices were 95% occupied and interest rates were 2%. Now offices are 60 to 70% occupied and rates are 7%. Borrowers can't refinance because cash flows don't support the debt at current rates and valuations. Banks will have to extend and pretend, giving borrowers more time and accepting lower payments, or they'll have to foreclose and recognize losses. Either way, bank capital takes hits. The vulnerable institutions are obvious. Regional banks with heavy commercial real estate exposure. Any bank that grew aggressively in the 2010s by making loans that made sense at zero rates but are questionable at 5%. Banks in cities with high office vacancy rates like San Francisco, New York, and London. European banks that never fully recovered from 2008 and are now facing new commercial real estate stress. Deutsche Bank in Germany. Italian banks. Banks in China facing property developer defaults. The list is long and the risks are interconnected. The data showing current stress mirrors 2007 remarkably. Credit spreads are widening. This means the premium investors' demand to hold corporate bonds over safe government bonds is increasing, signaling fear. The premium was around 100 basis points in early 2024. By late 2024 it's approaching 200 basis points. Not crisis levels yet, but moving in that direction. In 2007, spreads widened gradually before exploding in 2008. We're in the widening phase now. Bank stocks are underperforming. Regional bank stocks are down 20 to 30% from their 2024 highs despite the broader market being near all-time highs. This disconnect shows investors are nervous about banks specifically. In 2007, bank stocks underperformed for over a year before Lehman collapsed. The market was warning, most people just weren't watching. Commercial real estate transaction volumes have collapsed. Nobody's buying office buildings because nobody knows what they're worth. In 2007, residential real estate transaction volumes collapsed as buyers disappeared. Same pattern. Now let's map the timeline based on every 2008 pattern and current stress indicators. Right now through the second quarter of 2025, we're in the extend and pretend phase. Banks are working with troubled borrowers to avoid recognizing losses. Regulators are allowing accounting flexibility. The system is buying time hoping commercial real estate recovers or interest rates fall enough to make refinancing viable. This is like 2007 when everyone insisted subprime was contained. The problems exist but haven't forced recognition yet. The third quarter of 2025 through the first quarter of 2026 is when the breaking point likely arrives. Major commercial real estate loan maturities hit. Some high-profile defaults occur. Maybe a large office REIT goes bankrupt. Maybe a major developer defaults on billions in loans. This triggers forced recognition of losses by banks holding the debt. Bank capital starts eroding. Depositors get nervous. Social media spreads fear. Withdrawals accelerate. Some regional bank fails. This is the Bear Stearns moment of the cycle. The second quarter of 2026 is when the Lehman moment arrives. Multiple banks fail or need emergency mergers. The FDIC fund is inadequate to cover all the deposits. The government faces a choice. Bailout everyone, which means trillions added to already unsustainable debt, or let some institutions fail to send a message about moral hazard. If they choose the latter, it triggers panic. Credit markets freeze. Banks stop lending. The real economy contracts rapidly. Stock markets crash. We're in full crisis mode. So what do you do? How do you position before the next Lehman? Step 1 is understanding that cash and short-term government securities are the only guaranteed safe assets during a banking crisis. In 2008, money market funds broke the buck. Even supposedly safe assets failed. The only things that held full value were US Treasury bills and physical cash. For 2025 and 2026, you need 40 to 50% of your portfolio in Treasury money market funds or short-term Treasury bills maturing in 6 months or less. Not bank deposits beyond FDIC limits. Not corporate bonds. Not money market funds that hold commercial paper. Treasury securities only. Step 2 is identifying which institutions to avoid. Any regional bank with heavy commercial real estate exposure. You can check this by looking at their regulatory filings. If commercial real estate loans are more than 30% of their loan book, they're vulnerable. Any bank in cities with high office vacancy. San Francisco, New York, Chicago, Los Angeles in the US. London, Frankfurt, Paris in Europe. Any bank that grew rapidly in the 2010s and has a reputation for aggressive lending. These are your potential Lehmans and Bear Stearns. Don't keep deposits there beyond FDIC limits. Don't own their stocks or bonds. Step 3 is recognizing that shorting banks is difficult for retail investors but possible through puts or inverse ETFs. If you believe regional banks will crater, you can buy put options on regional bank ETFs or buy inverse ETFs that profit from bank stock declines. This is advanced and risky because timing is uncertain. You can be right about the direction but wrong about timing and lose money on options that expire before the crisis hits. But for sophisticated investors, this is how you profit from the next Lehman. Soros made fortunes shorting banks in 2008. The opportunity exists again. Step 4 is understanding that during the crisis, when banks are failing and markets are panicking, that's when you buy quality assets at depression prices. In March 2009, when the S&P 500 was at 660, down 57% from the peak, that was generational buying opportunity. Warren Buffett put $5 billion into Goldman Sachs in September 2008 when everyone thought Goldman might fail. He made $3 billion profit. He put $5 billion into Bank of America in 2011. It's now worth $40 billion. Not luck. Returns available to capital deployed during panic. Step 5 is psychological preparation for how brutal the actual crisis will be. Reading about Lehman doesn't prepare you for living through a similar event. When you watch banks fail, when ATMs are rumored to stop working, when financial media is proclaiming the end of capitalism, when your neighbors are panicking, your instincts scream at you to sell everything and hold cash under your mattress. This is when fortunes are made or lost. The people who panic sell at the bottom lock in catastrophic losses. The people who buy when doing so feels insane set themselves up for generational wealth. Here are the 5 specific warning signals that will tell you the next Lehman is approaching. Signal 1 is regional bank stock prices. Track the KBW Regional Banking Index. This index of regional bank stocks peaked around 140 in early 2022 before the rate hikes began. It fell to 70 during the March 2023 mini-crisis with SVB and First Republic. Right now in late 2024 it's around 90. If it falls below 70 again, it means markets are pricing in serious banking stress. That's your first warning. Signal 2 is the FDIC problem bank list. The FDIC publishes quarterly data on how many banks are on their problem list, meaning they're showing signs of distress. In good times this might be 50 to 75 banks. In 2008 it peaked at 884 banks. Right now it's around 66 banks. When this number starts accelerating past 100, it means problems are spreading beyond a few isolated cases. The FDIC releases this data quarterly. Track it. Signal 3 is commercial real estate delinquency rates. This data shows what percentage of commercial real estate loans are past due on payments. The Mortgage Bankers Association tracks this. Right now delinquency rates are around 1.5% for office properties, triple what they were in 2019. When this exceeds 3%, it means the problem has gone from concerning to crisis. In 2008, residential mortgage delinquency rates hit 11% before peaking. We're in the early innings for commercial real estate. Signal for is credit default swap spreads on major banks. Credit default swaps are essentially insurance against a company defaulting on its debt. The price of this insurance tells you what the market thinks the default risk is. During the 2008 crisis, CDS spreads on Lehman Brothers went from 100 basis points in 2007 to over 700 basis points days before bankruptcy. Right now, CDS spreads on regional banks and some European banks are elevated but not crisis levels. When you see spreads doubling or tripling over a few weeks, it means the market is pricing in imminent failure. Bloomberg tracks this real time. Signal 5 is overnight lending rates between banks. This is called the effective federal funds rate relative to what the Fed sets as its target. In normal times, banks lend to each other overnight at rates very close to the Fed's target. During the 2008 crisis, this spread blew out to 300 basis points as banks refused to lend to each other. If this spread starts widening significantly, it means credit markets are freezing and banks don't trust each other. This is the ultimate warning that panic has arrived. Your 90-day action plan starting right now must prioritize safety and positioning. In January 2025, move at least 35% of your portfolio to Treasury money market funds or short-term Treasury bills. Review where your cash deposits are held. If you have deposits beyond FDIC limits at any bank, especially regional banks, move them. Open accounts at multiple banks if needed to stay under FDIC limits everywhere. This feels paranoid until it saves you from a bank failure. In February 2025, set up tracking for the 5 warning signals. Create a spreadsheet or system where you update weekly with the regional bank index level, FDIC problem bank count, commercial real estate delinquency rates, and watch major bank CDS spreads. You're building a dashboard that will tell you when the crisis is accelerating from slow motion to imminent. Most investors won't do this work. That's why they'll be caught off guard. In March 2025, increase cash allocation to 50% if warning signals are flashing red. Build a watch list of quality stocks you want to buy during the crisis. These should be companies with minimal debt, strong free cash flow, and businesses that will survive a depression. You want their ticker symbols, current prices, and the prices you'd be willing to pay, which should be 40 to 60% below current levels. When panic hits, you need to be ready to deploy instantly without having to research in the chaos. From April through December 2025, this is when the crisis likely builds from contained stress to systemic panic. It won't be a single day like Lehman's bankruptcy. It will be a sequence of failures and near failures over months, each one worse than the last, each one testing whether the government will intervene or let markets clear. Your job during this phase is to maintain discipline. Don't panic sell. Don't chase whatever's working short term. Stick to your allocation. Watch your signals. Be ready to deploy when the moment comes. The parallels between 2008 and 2024 aren't subtle. In 2008, banks held assets worth far less than book value but used accounting tricks to hide losses. In 2024, banks hold commercial real estate loans and securities worth far less than book value and are using accounting flexibility to avoid recognition. In 2008, the trigger was residential housing collapse. In 2024, the trigger is commercial real estate collapse. In 2008, regional banks failed first before the crisis spread to major institutions. In 2024, SVB and First Republic in 2023 were previews. The major failures are coming. In 2008, government officials insisted the system was sound until it collapsed. In 2024, government officials and regulators insist that after Dodd-Frank and Basel III regulations, the system is safer. They insisted in 2007 too. They were catastrophically wrong. In 2008, the government initially tried to avoid bailouts to teach moral hazard lessons before panicking and bailing out everyone anyway. In 2024, the government debt is $36 trillion. The political will and financial capacity for massive bailouts is much weaker. They may let more institutions fail by necessity, not choice. In 2008, retail investors held stocks through the collapse and watched their portfolios lose 57%. In 2024, retail investors have been conditioned by 15 years of the Fed bailing out every decline to buy the dip. They'll hold through the decline expecting rescue. It will come eventually, but the damage will be done first. In 2008, the crisis took months to unfold, from Bear Stearns in March to Lehman in September to the panic peak in October. In 2024, with social media and mobile banking and algorithmic trading, the crisis will unfold faster. Bank runs take hours, not days. Panic spreads virally. The system will break faster. But there's one crucial difference that creates opportunity. In 2008, the Fed and Treasury eventually did whatever it took to stabilize the system. They cut rates to zero. They created quantitative easing, printing trillions. They bailed out banks. They guaranteed money market funds. They saved the auto industry. The kitchen sink. It took time and the damage was severe, but they ultimately prevented Great Depression too. In 2024, they'll try to do the same. But the starting point is much worse. Debt is multiples higher. Interest rates are already elevated. The ammunition is limited. The crisis will be harder to contain. This means the opportunities will be more extreme. Assets will get cheaper in real terms than they did in 2009. Quality companies will trade at valuations that reflect depression assumptions, even though the companies will survive and thrive. If you have cash and courage when everyone else is in panic, if you can buy Bank of America at $5 or Apple at $75 or real estate at 50 cents on replacement cost, which is what was available in 2009, you set yourself up for decades of compounding returns. But only if you're positioned before the crisis. Only if you have dry powder. Only if you maintain discipline when fear is overwhelming. Lehman Brothers didn't collapse because of bad luck or a misunderstanding. It collapsed because it took massive risks with borrowed money during a bubble, and when the bubble popped, the losses exceeded the capital. This is happening again right now with commercial real estate and bank balance sheets. The next Lehman is visible if you're paying attention. Multiple institutions are showing stress. The warning signals are flashing. The timeline is clear. The difference between 2008 and 2024 is that you have the historical pattern to learn from. You know what's coming. You know how it unfolds. You know how to position. If this gave you the exact playbook to position before the next Lehman-style banking crisis destroys unprepared investors and creates generational wealth for those who understand the pattern, hit subscribe. History doesn't repeat, but the cycles are undeniable. Banks overextend during bubbles. Assets become worth less than liabilities. Panic arrives. Failures cascade. Governments intervene too late. The prepared profit while the masses are destroyed. Lehman Brothers wasn't random. It was predictable. The next Lehman is equally predictable. The question is whether you'll be ready.